Hello, and welcome to Strategic Investment Group's latest FocusPoint webinar titled Investment Outlook, the Big Questions for 2017. One of our goals is to make this webinar as useful as possible to our listeners. So if you have a question at any point during the presentation, please type it into the Q&A box on the lower right corner of your screen, and Marcus or David will answer it once they've finished with their prepared remarks. My name is Jameen, and I'd like to introduce our speakers for today, Marcus Kriegier and David Ortobadi. Marcus is the Co-Chief Investment Officer here at Strategic, focusing on our economic and investment strategy outlook. And David is a Managing Director and Economic Counselor, one of the heads of our relationship management team, as well as a contributor to our investment teams and economic research. They have put together a very timely presentation for you today of what 2017 may look like. So without further ado, please take it away, David.
Thanks very much, Jameen, and thanks to everyone who's on the line listening. We hope to turn to your questions at the end, so please keep those questions in mind and send them to us as they occur to you. We thought it would be very useful to start with a brief retrospective of 2016, since many of the questions that Marcus is going to be addressing were foreshadowed last year. We thought we would do that by looking at, if you turn to slide 3, a very broad equity index, the All-Country World Index, which is in blue, and the 10-year U.S. Treasury yield, which is in gray. 2016 was a year of reversals and surprises. In the first quarter, if you remember, markets were really quite volatile. There were worries about a Chinese hard landing, potential Fed missteps, and the impact of plummeting oil prices on credit markets. All of these concerns drove risky assets very much lower in January and in February. These concerns abated in March, and there was a rebound that recouped the losses of January and February. This was a tough environment for active management. Macroeconomic issues dominated markets with little regard for security-specific fundamentals. Markets experienced widespread momentum reversals that were driven by swings in sentiment, not fundamentals. And these macro-driven momentum reversals wrong-footed active managers. After the volatility and reversals in the opening months of the year, markets got their first big surprise in June. Contrary to the expectations of most observers, the UK voted to withdraw from the EU. This vote set the stage for a protracted, messy, and high-stakes negotiation on the terms of the UK's withdrawal from the EU membership, and those negotiations are ongoing. The Brexit vote, surprised that it was, turned out to be a short-term shock from which global risk appetite quickly recovered. Despite the reversals and surprises of the first half of the year, equity and bond market volatility ebbed in the third quarter. We seemed for much of the third quarter to be in a period of relative investor complacency, as investors appeared resigned to a world with low growth, low inflation, and low interest rates. This complacency was shattered in November with yet another surprise, the election of Donald Trump. Like the Brexit vote, the Trump win took pundits and pollsters by surprise. Taken together, these two votes were seen as pointing to a resurgence in populist politics spreading across developed economies. If the election of Donald Trump was a surprise, the positive market reaction that followed was even more unexpected. Since the election, market sentiment has improved substantially. Investors expect that renewed fiscal stimulus and reduced regulations will break the low growth, low inflation, and low yield environment that has dominated the U.S. and other advanced economies since the crisis. There's renewed economic optimism and animal spirits in the air, and those have pushed equity and credit markets higher. After this year of reversals and surprises, there are a number of key questions to watch in 2017, and Marcus is going to be going through these, addressing these key questions. First and foremost, where are we in the business cycle? The recovery since the great financial crisis has been very long, albeit subpar. Is it about to come to an end? A related question is the Fed falling behind the curve, notwithstanding the Fed rate hike that took place only yesterday. Equally pressing question is, are markets getting ahead of themselves? We have seen a big run-up in equity prices since the November election. Have fundamentals changed? Are the policy expectations that are in part behind this run-up in equity prices going to be realized? Recall that last year, we were very concerned about the impact of a hard landing in China on emerging markets and the global economy more generally. How worried should we be about China today? We had the Brexit vote last year. Is there a chance that we'll move from Brexit to Frexit and see a severe undermining of the solidity of European institutions, or even the withdrawal of a major country like France from the Euro area as a result of the rise of populism in Europe? Finally, Marcus is going to bring it all together and answer the question, what does it mean for our portfolios? How are we positioned in light of all these questions? And with that, I'll turn it over to Marcus.
Thank you very much, David, for the introduction and setting up the agenda for this talk. Let's jump right in and let's try to find out where we are in the business cycle. If you turn to slide number 5, you have two very telling indicators that we like to consult in order to determine how the global economy is doing. On the left-hand side, you have the Global Purchasing Manager Index, which is our proxy for global growth. It is based on a large number of surveys that are conducted with individual firms that give information about the level of activity in their institutions, their expectations, and so on. Now, we have broken it down by a composite that includes manufacturing and the service sector, and by manufacturing. And when this indicator in the left panel is at 50 or above, then the respective economies are expanding, and taking that rule and examining it in the left panel, we can see that for the past year, the global economy has been expanding at an accelerating rate. So we touched onto relatively low levels in the first quarter of last year, and ever since have seen a fairly solid acceleration. What is even more important and interesting is that this acceleration has been very broad-based. It happened in the US, it happened in the Eurozone, but it also included China and emerging markets. So it is probably the first time that we have seen a broad-based rebound in global activity. On the other hand, on the right-hand side, we have some information on inflation. And again, a similar picture emerges. It was not too long ago that we were actually contemplating whether we would fall into a broad-based deflation. And of course, ever since, we have seen a rebound in inflation, particularly in the US. And more recently, that has been followed through by more countries, as captured here by the G7 CPI index, helped by a rebound in commodity prices. So I think the takeaway from this slide is that we have moved from deflation or deflation fears to a relatively broad-based reflation that has given us a rebound in growth and inflation. Now, let's move to the next page, and let's tackle a question that we hear whenever there are some positive signs, particularly out of the US economy. Does the rebound mean that we are facing or that we are heading towards another recession? And that question is based very often on the fact that usually that the distance between recessions is approximately 60 months, 5 to 6 years. We, of course, have surpassed that time period since the last recession. Now, a good way to answer that question, we think, is by utilizing an analysis that has been produced at the New York Fed, which is having a look at a recession indicator in the form of the spread of the US yield curve. What you have on that slide is the spread between the 10-year Treasury yield in the US and the 3-month T-bill rate. Historically, we have seen that whenever that spread inverted, so when the yield curve became inverted, it took another 12 to 18 months on average to see a recession in the U.S. The recessions are marked in gray on the chart on slide number 6. Now, using that measure, we are currently diagnosing that we are nowhere close to a recession. As a matter of fact, the New York Fed computes that the probability of a recession over the next 12 months is just slightly ahead of 4%. So recession is not a major concern at this point in time. Now, on the next slide, we're moving on to ask ourselves, what does all of this mean for central bankers, particularly for the Fed? And we've all watched, of course, the outcome of the FOMC meeting yesterday with the 25 basis points increase in the federal funds rate. Now, in order to judge the longer-term outlook for the Fed, let's have a look at the chart that shows the dual Fed target comprised of a 2% target for core PCE inflation in the U.S. and an unemployment rate in the vicinity of 4.7 to 5%, which is usually what we think represents full employment in the U.S. economy. And you can see that after a very busy journey since 2004, we have approached what we could call the bullseye. In 2017, we're close to both targets for the Fed. And of course, that immediately reminds us of a statement that Janet Yellen made last June, where she reminded us that monetary policy works on the economy with a lag. In other words, if you want to calibrate your policy correctly, you have to start to withdraw accommodation before you actually hit your target, before you hit your bullseye. Now, we are nearly there, and policy is still very accommodative. We would conclude that the Fed, whether intentionally or unintentionally, has fallen behind, particularly given the lags that we just mentioned, and that we should be prepared for an acceleration in the scaling back of accommodation, as was mentioned by Janet Yellen only 2 weeks ago. So there is risk of catch-up. Now, on the next slide, slide number 8, we will take a look at how markets are comparing with respect to their expectations of short-term rates of Fed funds rates, and compare the expectations with the projection that was delivered to us by the Fed yesterday afternoon. Now, the dark blue line in that chart represents the FOMC projection of its policy rate into the medium term and then longer term, with an expectation that the Fed funds rate will plateau at 3%. The teal line represents market expectations of that very rate 6 months ago, and you can see that markets basically assumed that the Fed would not be hiking rates anytime soon at all. And the gray line is the expectation for the Fed funds rate, market expectation for the Fed funds rate as of yesterday. And you can see that while the expectations have converged with the Fed in the short term, there is still a sizable gap between the gray line and the blue line when we move out to 2018 and 2019. So what we conclude from this chart and from this analysis is that there is, first of all, the risk and the likelihood that markets will have to catch up with the Fed's projection of rising rates over the next couple of years. And we also have to allow that the Fed itself might be revising their own projections higher as the economy is recovering. And if we put all of this together, we have to probably prepare ourselves for higher rate expectations that will filter through to bond markets in the U.S. How about sentiment and market responses in equity markets? And on slide number 9, you have a chart that has two measures. The one is the well-known S&P index since the beginning of 2015, and in blue, we have an index that actually measures the economic surprises that have been occurring during that same period of time. Economic surprises are measured as the difference between the market consensus for a whole host of data that is published throughout every month and the actual realization of that particular data point. And what you can, and these are measured in z-scores or standard deviations. And what you can see on this chart is that pretty much since the first quarter of 2016, the blue line has been increasing. So the process of positive surprises started to get underway, admittedly, from a very depressed state of the economy at that very point in time. Now, since the U.S. election that David alluded to in his introduction, we have seen a further pickup in positive economic surprises. At the same time, we also see from this chart that equity markets have moved in sync, hand in hand with these positive surprises. Now, when we take a look, particularly at the time since the U.S. election, and we drill down into the economic surprises, we see that a lot of these positive data surprises are related to survey data, consumer confidence, business confidence, and the like. So what we infer from that is that there is a healthy amount of positive expectations for the economic outcome in the U.S., in part related to the policy agenda, the fiscal policy agenda, which has triggered expectations for growth-supporting fiscal policies that might be implemented this year and next year. So let's have a look at expectations and possibly uncertainties that might give us a better read on how to handle this optimism among firms and households and, of course, investors that we diagnosed on the previous slide. And on slide number 10, you have two what we find quite interesting measures. The one is a measure of risk perception. It is the Global Financial Stress Index that contains a large number of global measures of risk perception, like implied stock market volatilities, implied currency market volatilities, credit spreads, you name it. It's all in there. The higher the index, the more risk is perceived. The lower the index, the more complacent with respect to risk investors are. And what we see on the left-hand panel is that compared to previous crises, risk perception is relatively low. So there doesn't appear to be any concern that we should be looking for some form of insurance against negative events in the global economy or in the marketplace. Now, we contrast that with some information on the right-hand side. The right-hand panel shows you the economic policy uncertainty index that has been constructed by economists at Stanford University, and that captures the uncertainty with respect to global economic policy, fiscal policy, regulatory policy, you name it. It's all in there. It is explained in the footnote, so I'll spare you the details. But what we see from that panel is that with the last readout for February 17, that even though that uncertainty index has come down a little bit, uncertainty remains at relatively elevated levels compared to the history over the past 20 years. So on the one hand, we have very little risk perception or even complacency. On the other hand, we have a lot of uncertainty. We think that those two messages create a tension that needs to be taken into account when building a portfolio, because we believe that sooner or later there will have to be an adjustment in one of the two or in both. Either risk perception increases or the uncertainty comes down. We have no indication at this point how that adjustment will happen. Now, when we think about adjustments, it might be useful to try to identify potential triggers that might sap some of that optimism that is currently priced into the market, particularly into equity markets in the U.S. And one topic that we have been discussing internally a fair bit is the current stance of the new administration on trade policy. The focus is generally on fiscal policy and on regulatory policy. However, we are aware, and we have been made aware even during the campaign, that one of the important aspects for the new administration will be trade policy. And there's a lot of work in the background to reshape the setup of trade policies. Now, we know that the administration is the new administration is skeptical of free trade and is at least in part aiming to reorder U.S. trade relations. Now, we believe that this is a very tricky issue, and it is tricky because of some of the information that is contained on slide number 11. Slide number 11 shows global value chain participation rates. Now, global value chains are very pervasive in today's global economy. The way we measure global value chain participation is by measuring the fraction or the percentage of exports that is impacted by global value chains, either through inputs that make foreign imports that are inputs into U.S. exports, or U.S. exports that themselves become inputs in foreign trade and can therefore be measured as a fraction of country-specific exports. So let's take an example. Let's take the United States. What that measure tells us is that 45% of U.S. exports are impacted by global value chains. If you go to a country like the United Kingdom, you can see that nearly 3/4 of UK exports are impacted by global value chains. If we were to move to a trade regime that aims to reorder those value chains by, for example, replacing multilateral trade agreements with bilateral trade agreements, we could foresee that we will see, at least temporarily, a severe disturbance or disruption of trade flows, which in turn would, of course, impact global activity, economic activity, pretty much across the board, whether it's in developed markets or emerging economies. That's one example of the uncertainty that is currently in the system and that probably needs to be taken into account when forming views on the backdrop for our asset allocation. So there's a potential for growth disruption. Let's switch focus and let's move over to a point that David mentioned in his introduction. Should we be worried about China? Now, we mentioned in opening that a year ago, China was very high up on everyone's worry list. At a time where everybody was afraid of a crisis, we cautioned because we felt that there was no imminent crisis at hand. We agreed that there has been a very substantial rebalancing that came in sync with a decline in Chinese GDP growth, but we felt that this was relatively well under control of policymakers in China. The other aspect that was a market focus at the time was the growth in Chinese debt and the growing imbalances in the Chinese financial sector. Both elements are shown in the two panels on slide number 12. On the left, you have the spectacular increase and then the following decline in Chinese GDP growth, and on the right, you have that increase in debt. We believe that, again, markets have been too extreme. Worrying, being afraid of a crisis a year ago, now it appears that no one is talking about China any longer. Now, we still think that China should be on every risk radar screen without being afraid that there is an imminent crisis. But we are clearly monitoring it very carefully because the sheer size of China warrants to be very aware of any risk, be it on the growth side or be it on the financial side, that might emerge in an economy that has traditionally been somewhat opaque and difficult to read. So be assured we are paying close attention to everything related to China, but we're not in any panic mode at this point in time. And let me finish off that trip around the world with a couple of remarks on Europe. Now, if Brexit and the Trump election last year were disruption 1.0, then there has definitely been a lot of talk recently about disruption 2.0 in the form of a spillover of those phenomena to the European Union. Now, you might have all heard that loud sigh of relief that came out of Brussels and the rest of the European Union yesterday after the election in the Netherlands, where the anti-Euro populist party did not live up to some expectations, and it seems now relatively clear that there will be no participation of the anti-EU forces in the Dutch government. Focus is shifting very quickly to France, and David already mentioned that in opening. The French elections in April and in May, with two presidential rounds, have a populist anti-EU presidential candidate, Marine Le Pen, running relatively well in the polls, very likely to win the first round, before then the two frontrunners of the first round move into the second round in May. Now, polls are indicating that the probability of an anti-EU win in the second round is low. However, after Brexit and after the US election, we have chosen to be somewhat cautious about getting too comfortable with poll results and the interpretation of poll results. So we would still treat an anti-EU vote in France as not as our baseline scenario, but at least as a tail risk that we have to think through. Now, initially, we would expect turmoil in the marketplace following an anti-Euro, anti-European Union vote. In the longer term, however, we don't think that this would necessarily spell the end of the European Union, and the reason is found in the chart on slide number 13. Slide 13 tells you the attitude of the population in the euro area towards the euro. Now, 70% in that survey that was taken in October and November of 2016, so it's quite up to date, 70% are in favor of the euro. And this is a very broad-based result that extends from the so-called periphery all the way over to the core members of the euro area. Now, 70% support for the euro is what we think a relatively strong firewall, because you cannot leave the European Union without leaving the euro, and you cannot leave the euro without leaving the European Union. So we believe that with that firewall in place, even a negative outcome does not necessarily spell disaster for Project Euro. Now, that's important because part of our portfolios are invested in Europe, including the euro area and the UK. So let's step back and let's ask ourselves what these insights and results imply for the portfolios that we're managing for our clients. Now, let's have a quick look at valuations. Valuations are a very important input into our asset allocation decisions. On slide 14, you have a picture of the 10-year U.S. Treasury yield. And the picture is very long. It's a very long window. And it's long on purpose because it is meant to put the recent backup in yields into perspective. Now, while 100 basis point backup, or even more than that, 120 basis points since last July, seems impressive, when we compare that to where we're coming from, we feel that there is significant upside for yields if we were to see a continued reflation of the U.S. and the global economy and a pickup in inflation, and if we were to see the Fed increasing short-term interest rates as signaled, among other things, in yesterday's meeting. So we are still in a mode where we view bonds as very vulnerable going forward. On the next slide, you have a quick look at our equity valuation model. The model shows you 4 key equity markets that are represented in the portfolio, and it shows the equity price to fair value. At a level of 1, markets are at fair value, so no valuation signal. And as you can see on the right-hand side, there are some deviations from fair value. They might not be screaming signals, but there are some signals which tell us that the U.S. is overvalued at this stage, and the Eurozone, Europe, including the U.K., and emerging markets are undervalued. And you will find those results in a second when we go through the overall allocation, which is on slide number 16. Here, just a very, very big picture, high-level overview of how we view asset markets at the moment and how they are implemented in the portfolios we manage for clients. Equities are held at a neutral allocation overall, so on policy weight. Uncertainty that we mentioned before, in combination with valuation signals, suggests to us neutrality for the asset class overall, but some structuring inside the asset class, underweighting the U.S. and overweighting Europe and emerging markets. Now, these are very small deviations because we don't place a lot of confidence and a lot of weight on those valuation signals at this stage. On the right-hand side, fixed income is at a clear underweight. We think that increasing yields will be weighing on bonds, and that is particularly expressed with underweights to U.S. Treasuries and investment grade. We do have some exposure to high-yield credit, where we see good opportunities for security selectors. There are good opportunities for the managers that manage the high-yield portion and pick bonds rather than making macro calls. We also keep a small underweight on inflation-linked bonds. Real yields are very low and do not appear attractive to us at this stage. And we keep an overweight to hedge funds. And that is an expression of our confidence that the opportunities for active management going forward will continue to improve. They have already improved over the past 2 quarters and are likely to improve going forward. Now, that concludes the prepared remarks, and I think we had a few questions rolling in, so let's turn to those.
Thank you, Marcus and David. We're now going to kick off the Q&A session. And participants, just as a reminder, please type your questions into the Q&A box you'll find on the lower right-hand corner of your screen. We did have some questions come in during Marcus's prepared remarks, and David's going to take that away.
Right. I think the first question is a 2-part question, Marcus. The first part is, shouldn't we expect a divergence in yield between the U.S. and Europe because the Euro area isn't going to be able to raise rates as fast as the U.S. given where they are in their economic cycle? And if that's the case, should we expect that the pace at which U.S. interest rates go up will be dampened by outflows from the Euro area?
Right. This is actually this is a very interesting question, which touches on a little research project that we have just kicked off actually this week, trying to understand how particularly the European and the U.S. bond market are relating to each other. In other words, which market causes market moves in the other one. We have done a causality test. Now, the old wisdom has always been the U.S. drives the yields in every other government bond market, at least in the G7. That has reversed to some extent following the Eurozone crisis, when the ECB overwhelmed global markets with liquidity and with a very aggressive quantitative easing policy, which showed for the first time that exactly those flows from the Eurozone into the U.S. that you alluded to, David, can actually create a very strong impact on U.S. Treasury yields. Now, the first result is that the impact or the influence of Eurozone yields on the U.S. has weakened again. It was very strong after the Eurozone crisis. It has weakened somewhat, and that would, of course, open the door for the divergence that you alluded to. On the one hand, U.S. Treasury yields that will increase in response to all those domestic factors that we touched on during the presentation. And on the other hand, the Eurozone policies that still see a lot of central bank support for the domestic bond market. Now, we have already seen the divergence of bond yields between the two markets, so there is some chance that this might continue. There is a little bit of a qualifier here, and that has to do with the ECB policy. And there have been first hints of the ECB that go in the direction of signaling very carefully a potential taper. And that, of course, could cause somewhat of a reconnect between the two bond markets.
I think the issue of interest rate divergence goes very nicely to the next question that we've received, and that question is on your views on the dollar. How do you see the dollar?
Yeah, that's indeed very closely related. Now, while in the very long term, the dollar or currencies in general are value driven, and we maintain our own purchasing power parity related valuation models, we know that in the short to medium term, expected interest rate differentials are a very important driver of currencies, of exchange rates, bilateral exchange rates. And as a matter of fact, if we were to, for example, pick the euro dollar and we were to plot the euro dollar against interest rate expectations, for example, 12 months ahead interest rate expectations, we would get a very nice fit of those two financial time series. Now, what does this mean? What does this imply? Well, it would imply if we were to see more divergence in expected interest rate differentials, as they could result from a faster pace of Fed tightening, then that should be positive for the US dollar relative to the euro or to the yen, and to some extent to emerging market currencies. So the risk still has to be seen for a stronger dollar. Now, we do know that currencies tend to be very fickle animals, and they can move around and be very volatile. But I think we still have to keep an eye on potential dollar strength going forward.
We have another question that I like a lot. I think it's a very good question, and it builds on what you just discussed. You've painted a scenario of a rising dollar and higher U.S. interest rates. This question wants to know, all right, you've talked about China. What are your views for emerging market, the outlook for emerging markets more generally, given tightening global conditions with the rising dollar and rising interest rates?
Right. Now, this is very relevant also because, of course, emerging equity markets play a very important role in our portfolios. Now, we're all conditioned to think that if the U.S. hikes rates, the dollar gets stronger, and this must be bad news for emerging markets and emerging equity markets and emerging economies. Now that still goes back to the time when I think the fear, well, first of all, you had a lot of emerging markets that were dependent on capital inflows, and both factors tended to reverse those capital flows to emerging markets. And I think the world has changed, and it's very important. You mentioned China, to include China in that picture. Now, as long as we do not see a precipitous increase in U.S. rates and very significant capital flows away from emerging markets, we would conclude that emerging economies in general are actually quite well diversified, because on the one hand, we have a relatively well-performing Chinese economy that is providing still good support for commodity markets. That is important for the large number of commodity exporters among the emerging universe. So that's an offset, if you want, and that creates a positive backdrop. And on the other hand, we have seen over the years an improved policy setting in many, I'm not saying in all, but in many emerging economies that has raised the ability to withstand these kinds of capital flows that I alluded to in the beginning to the answer. So to sum it all up, while there will always be individual countries that might see some stresses, we feel that emerging economies are well positioned to withstand an orderly withdrawal of accommodation, monetary accommodation, particularly if it happens against the backdrop of a healthy global economy which provides other forms of support that tend to offset these capital flow considerations.
You mentioned previously about the possibility and the hints that the ECB has given that they might taper. I think that's whetted the appetite for more information on the ECB by one of our listeners. And so could you elaborate on your views for ECB policy?
Yeah, I think the ECB, it's very important to extract if you want, the sign language and the signals that are transported in press conferences and speeches by, for example, Mario Draghi. Now, and the reason is that a lot of the ECB policy, particularly during the crisis, relied on trying to guide market expectations. Now, what we're very likely to see is a glacial switch in monetary policy out of the ECB. Glacial because the ECB still is concerned about pockets of weakness in the euro area, while at the same time other parts of the euro area are moving quite briskly. Growth in the core, Germany, Holland, is strong. Inflation pressure is picking up. So what we should prepare for is to train our ears to these signals that, as I mentioned earlier, might hint at a possibility for a taper in the short to medium term. Now, this taper, the taper of the purchases, the quantitative easing program, will be very, very gradual. However, we have to be prepared for those signals because they mark a very sizable, a significant deviation from a policy that has been in place for 6 or 7 years now. And markets not only in the Eurozone, but in the Eurozone as well, have gotten very used to the prospect of literally unlimited liquidity. If we were to get a signal, which could very well happen over the course of this year, out of the ECB, that there will be even a gradual shift in that policy that could have an impact. It might impact currency markets, it might impact bond markets, and it is definitely something we have to be very, very, very careful about.
I see that Jameen is signaling us that we're running out of time, so I apologize if we don't get to all the questions that we received, but I think there's one more that we might have time for, and we haven't touched on it yet. And that question is your views on corporate credit markets. and valuations. We saw wide swings in segments of the high yield market in 2016, mainly driven by energy, and we've seen a tremendous recovery in some lower credit quality portions of the credit markets in the last 10, 12 months.
Yeah.
Could you elaborate on that?
Yeah, I think it's our view on credit markets in general is that we have actually progressed well into the overall credit cycle. Now, the credit cycle has been somewhat dislocated due to the energy-related events that you mentioned in your question. But I think it's fair to say that from a valuation perspective, the market is not that attractive any longer, and the overall credit stance in our portfolios is now underweight. So particularly in investment grade, we're not particularly attracted to investment grade credit because you have, on the one hand, the interest rate sensitivity of investment grade credit that is a risk to the asset class. And on the other hand, you have credit spreads that actually have become expensive to their own history. So on that front, we have become defensive on credit. But we do concede, and this is what I hinted at during when we walked through the slides. There are still plenty of opportunities for skilled managers to extract value from the high yield segment of the market, and we like that because that is usually implemented with very little exposure to interest rate risk in the market. So we're insulating the portfolio from that trap, if you want, on the fixed income side, and we do think that those opportunities will remain active at least for some time to come, and then we're quite committed to those allocations that look for value in the high yield segment.
Okay. Thank you, Marcus and David, for sharing your insights with us today. With that, we will conclude our webinar, and thank you to all our listeners for tuning in. Have a great afternoon.